Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets, which again hit record highs. Ross examines gold, silver, copper, uranium, crude, Bitcoin, and the U.S. and Canadian dollars. Editor of Rick's Picks, Rick Ackerman weighs in on silver, copper, AI, Bitcoin, and lithium. He also has a very interesting near target for the price of gold. The founder of the Schachter Energy Report, Josef Schachter, joins us from Calgary to discuss the oil patch and beyond. He looks at the prospects for energy with recent geopolitical events in mind, especially in Venezuela and Iran. He also comments on Alberta independence. Then we zip down to San Diego to chat with Robert Campbell, publisher of the Campbell Real Estate Timing Letter, to discuss the U.S. economy and whether lowering interest rates would boost the housing market. He also has some fitness tips for us. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Pleasure to be with you, Jim.
How would you describe what happened on the stock markets this week?
Well, it's from my perspective, it's more of the same. The big cap names and the Mega 7 that were just our leaders through most of last year. They topped in November and have been going sideways at best since then. The big names, the Meta, Microsoft, Apple, Netflix, Tesla, all just going down week by week at this point and just giving up ground. So the transition and rotation is truly in force. You've got the small cap indices, the Russell 2000, the mid cap index, the MDY, and over into the unweighted S&P. So that's the RSP. That's the ETF there. Is doing exceptionally well. All three of those have hit new all-time highs this week. So clearly that is the place to be. It's not in the big cap names because they've had their run, and I still think this is like 2000 when the dot-coms topped out in March, April, and then the rest of the market did well into the July-August stretch, and it wasn't until September that everything started to fall apart. So we're in a phase like that where this market is topped out. We're now 2.5 months since the top of the big caps, and they're going nowhere. And this is probably part of a rolling top at some point here. When the S&P breaks down through its 50-day moving average, we'll start to see a more concerted move on the downside. In the meantime, the sectors that are doing well, clearly we know that the metals, that be gold and silver, have been leading the pack. Copper has joined in there and done exceptionally well since the summer. The oil indices, for all that oil has been in a downtrend, if we take a look at the oil services, that's the OIH, or you look at the XLE, or in Canada, the XEG, those ETFs have been just walking up nicely. It's the place to be these days. So, don't fight the trends, work with them, and in this case, those are the ones that are providing the returns.
What's going on with gold and silver?
Okay, so gold has just been stair-stepping its way up quite nicely. We're sitting now with a spot price at $4,590, and having a little bit of trouble here, keeping its momentum going. But as long as the pullbacks stay in reasonable fashion, and I think that's probably around, if we hold the 4,400 level in the spot gold price, that's pretty healthy here. On silver, we got up to $92, and I've got the index that we developed, the exhaustion index, has various levels that it can go to, and it went to an extreme exhaustion level this week. It's very, very minor occasions that you see that. Typically, you see a pretty good correction after that. So silver at this point is starting to correct. At the end of the week, we're down to $88.50. There's probably more in terms of a correction at this point. And the miners have been doing reasonably well, whether it's the gold miners or the silvers. The juniors have had an excellent run this year as well, last year, and they're ready for a bit of a pause.
What's going on with the U.S. and Canadian dollars?
U.S. dollar, we haven't been looking for anything significant since the double bottom went in place. We did get up and see decent resistance at the 50-day moving average. Then we backed off. At this point, we're just in what I would say is a consolidation phase. I think the odds still would point to higher prices rather than lower prices. And on the Canadian dollar, that went 2 weeks ago. The commitment of traders numbers, now that we have valid numbers from the government, and it was months there where there wasn't anything, but the COT levels show extremes as far as both the commercials and the speculators are concerned, which makes the Canadian dollar vulnerable. You got too many people on the same side of the trade. And also, if we take a look at the dollar relative to commodities and crude oil, it's not doing terribly well here. This was a solid week to the downside. And on the other side of the coin, the crude oil market was doing very, very well. And if anything, when you see such a divergence as this, then it's a negative omen for the Canadian dollar.
What's happening with Bitcoin?
Bitcoin, we had just the perfect bottom in here. You had that major downside capitulation in November, the first decent bounce, then a retest of the low in December, and the moving averages crossed a week and a half ago to the positive side, and since then we've gone from an 88,000 level up to 95,000, and this looks as though it's got more to go on the upside. So enjoy the ride at this point. The moving averages like the 20 and the 50-day are in the process of putting in a cross. We had shorter-term averages provide the buy signal 10 days ago, and now you're getting more of the intermediate side as far as the upside is concerned. I guess the last item is uranium, and really we have liked this one since it put in some good numbers on the downside. There was in November, we ended up with Cameco and URA, URJ, putting in nice lows. Those were tested in December and with springboards, so that became oversold in rising trends. And here we are, Cameco, in terms of U.S. funds, we've gone from 77 up to 116 just in a span of 2 months, and got a little ahead of itself as of this week. So I wouldn't be surprised that maybe it pulls back by maybe 5% or so, but overall, that trend as far as the uranium is concerned is just nicely in place. So enjoy the ride.
Ross, thank you for that glowing report.
You're welcome, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Rick Ackerman next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website rickackerman.com. Today he's speaking to us from
sunny but unseasonably chilly Florida.
Rick, silver's on the move. Why is it moving, and how much higher could it go?
First, let me thank you for inviting me on. It's always a pleasure.
Oh, thank you.
How much higher could silver go? I've got a target of 103 right now, and I don't want to say that will be the grand super top, but I do think it'll get there. The March silver contract currently trading 88, down close to $4 an ounce today. But yeah, I think it's still got a little bit of a move left in it.
Copper is over $6 a pound. Is copper signaling an economic boom ahead?
I'm not sure. I'm going to come to that in a second. But to come back to silver, I did have some good conversations with two people who know a great deal more about silver than I do. One is Sean Rakimov of Silver Strategies, Peter Spina of SilverSeek, and Sean gave me kind of an overall view that's kind of interesting, that talks about how you hear these stories, they've been valid, but it's only when silver starts kicking up a fuss that the stories get kind of flushed out. But one of them is that COMEX is no longer settling the price. It's really demand that's creating price, the quotes, bids, and offers. And we have a whole world really that's coming to silver the way the U.S. manufacturers have long been users of silver. So global demand is there in a way that it hasn't been, and that's why Sean seems to feel that this time the price of gold and silver are not simply rallying to some bull market top. They're going to essentially stay high for, well, I'm going to say the rest of our lives. But, you also have a number of countries, China, Russia, the U.S., India, they're all hoarding silver in a big way. They're starting to lay in to store the stuff. And the rest of the world's really going to have to start following through. We're going to see a lot of countries start sucking up silver and for more, and as I said, increasingly industrial uses. And we've got additional demand coming from places like Tesla's about to come out with a silver graphite battery that would change the demand situation. There are rumors that Samsung actually bought a silver mine in Mexico presumably to ensure its supplies. So all kinds of silver stories are breaking out now, and again, bottom line, I don't think we've seen a top there. But coming back to copper, it's interesting, and I've kind of resisted the idea that the world was on some sort of industrial, on the threshold of some boom. I would say that maybe copper's been as high as $6.11 a pound on the COMEX, and that's just shy of a pretty important target I've got on the weekly chart at $6.24. It's sold off a bit, is currently trading $5.81 a pound, but I think it's got one last rally till it actually touches that $6.24 target of mine. So at that point, I would like to take another look at copper. If it blows through that target, which is what I call a hidden pivot resistance, then it would suggest even higher prices. And it gets a little harder for me to justify the idea that copper is simply a go-along inflation hedge at this point, that there are many uses for copper that are summoning industrial demand that was not there perhaps 3, 4, 5 years ago.
Well, one of the demands for copper, I'm sure, is maybe not in the U.S. and Canada, but EVs are now really booming in Europe and in China, and you have to use so much more copper to build an electric car than you do for an ICE engine.
True. Ironically, you use less steel but more copper, and so yeah, we have quite a bit of demand for it from the EV industry. I think China actually just passed Tesla in certain sales statistics of EVs. So, and I'm trying to remember what the specific statistic was, but China now is really gobbling up the market.
And they're the biggest car buyer in the world now.
Yeah, and it's obviously hard to sell into a domestic market that can pretty much meet any possible demand. China's not exactly open to EVs from around the world, and but they can certainly export at a cost that makes them competitive, even in countries that have a 30 or 40, even 50% tariff on electric vehicles.
AI, artificial intelligence, is next-level programming that can't think for itself. Is that a fair statement, and should AI be trusted?
It should not be trusted. I was pretty impressed. I think it gives, my experience is that it gives very interesting medical advice. Its way of getting at your symptoms is much more rigorous, I would say, than any internist that I've sat down with. It just seems to ask the right questions to pin you down to, what's going wrong. So I think it does that pretty well. But another area would be in tech support, which I use. I'm unfortunately a ravenous consumer of tech support, maybe 2 hours each and every day for, well, you name it. It's something different every day. But I had a problem with one of my key applications that I use for trading, and I queried ChatGPT, and it gave me a sequence of things to do, and I had to come back and say, well, that's not a correct sequence. I can't even find such and such in the pull-down menu. And then it said, oh, okay, here, let me try that again. And it did, and it got it wrong again. And I said, look, stop shucking and jiving. Give me a good answer. So it says, oh, well, we're really sorry. I'm sorry. Here's the real skinny. This is the lowdown. We're going to strip out all the other stuff and give you just a straight answer, what you need. Proceeds to give me another wrong answer. It repeats that one more time, and I cursed the thing out, and it in its stupid, like brainless way, it gets the message and says, look, give me one more chance. And it gives me another bad answer, something that doesn't solve my problem. And I come back at it really hard, and it says, well, okay, we got to fess up. There really isn't a way to solve your problem. So I called the applications company, its TradeStation, and I got some of their escalated support, and it turns out there is an answer for my problem. So anyway, I went through all these steps with ChatGPT to go nowhere, and just as the story that I just laid out, and that does not bode well for tech support, which is already bad enough. You cannot reach a human being right now. We're getting close to the point where there's no longer human support for any product, and this includes some of the last holdouts that are still providing human beings on the phone. One is Brother Printer, No, actually, I'm sorry. I think it's harder to reach a human at Brother now, too. But Logitech and Bose were two companies that I thought would always put humans on the phone. But I think they're getting toward the end of their string, too. So to the extent that AI tech support is going to replace humans 100% in support, it's not. I don't think it's going to bode well.
The stock markets keep going higher and higher. Do you see a possible stock market top anywhere in the future?
Well, I've kind of, I don't like to waffle, but in my last few months worth of commentaries in my own newsletter, Rick's Picks, I've described the market as in a topping process. And at this point, I'm willing to just put that aside. That's my own bias, really. But I can't tell you for certain, I can't give you an ironclad guarantee that the Dow isn't going to double again to 100,000 in the next 3 years. And, you know, when you try to read the market based on what you think of the world, it never works out well. The market has its own mind, and it doesn't really care what the news is or even what earnings are. We're just in this huge bull cycle. But that said, I'd be cautious here only because we're right at the very round number in the Dow of 50,000, and even the S&Ps are at a very round 700. And gold at 5,000. So I don't know whether the coincidence of all these big round numbers means something, but I'm somewhat cautious here with the market, although I'm ready to go with it if the rally just breaks into new territory.
Could the stock market affect the U.S. midterm elections?
It's hard to say what will affect them. I guess every publication, everybody's got their point of view, really. And I think Trump is probably weakest on this whole affordability issue. He's promised more than he can possibly deliver. And when he talks about the progress being made in this affordability area, it's just little stuff. It's, the big picture where affordability is concerned, pivots on the cost of your housing, your health care, and a few items that Trump has not even begun to address. So although he can claim some successes, and of course we've had I never quite trust a drop in the price of fuel, but that's been a big break on the inflationary front. It's not insignificant either, because there's an energy component in pretty much every cost that we experience. But he can't win there, really, and I don't think if we get to the 2026 election and things are as unaffordable as they ever were, which I think will be the case, that's going to present a problem for Trump. But his biggest advantage, and it may more than offset the affordability issue, is that the Democrats are going to have to wind up fielding somebody like Gavin Newsom, and I can't think of a candidate that the Democrats could run that would give, I guess it's going to be Vance, a serious challenge. But of course, the attacks on Vance have started well in advance of the election. So by then he will have been Hitlerized. But I still think that the economy is going to be the most significant issue.
Has Bitcoin seen its day?
It would seem so. I put out in my own, I track Bitcoin regularly, and I threatened to take it off my list just because the whole idea of Bitcoin is so silly. And it's not particularly difficult for me to forecast. My method is good with violent, sleazily manipulated vehicles like Bitcoin, and it's not hard at all to get the swing highs and lows to trade it. But I put out a chart this week that shows a kind of homunculus figure, eyes and a smiling mouth, of a head and shoulders formation. And on a chart, the head and shoulders formation is kind of, it's a very well-known bearish indicator, unless, of course, it's inverted. But this one looks pretty real, and it's very compelling to the imagination to put that right shoulder there. So if we rally up into the right shoulder, it would give us a Bitcoin high somewhere around 110,000, I think it was, before Bitcoin goes down for the count. So anybody who didn't learn the last time around when Bitcoin came from low 70Ks to, I think it was 14,000, anybody who didn't learn the lesson is doomed to repeat it, which was that at that time, 2,000 boutique flavors of crypto, they were all completely unnegotiable. And I had signed on with a particular type of Bitcoin, a boutique flavor that was marketed in the way that Tupperware was. People would have parties and invite their friends and tell them all about this fabulous new way to triple their money. So I put a few $1,000s into it just to see how it ran. And it gave me a chance to it gave me some insights into how the business works. And in this case, and in most others involving the crypto Bitcoin, there were a bunch of sleazy, well, let's not mince words, a bunch of scumballs, Asian billionaires who were promoting it. And when it went down in flames, I was surprised to see that they kept everybody on the hook. They said they put out rumors that everybody who put money into their venture would eventually be made whole. Everybody would get their money back. And it made me curious why they would make that offer. But I guess you could say it was inspired by true bullishness on their part. They basically were operating on the idea that if Bitcoin ever revived, they had this huge mailing list of suckers, pigeons, rubes that they could market to, which is what they did. So Bitcoin did come back, and it was only when Bitcoin rose to the point where it took these guys out of the muck that they were able to, in a sleazy way, just substantiate the rumors. In other words, they weren't on the hook as long as it was merely rumored, and you couldn't find out the truth. Well, are these guys going to give us our money back or what? And they, by the way, did not give anybody any money back. They gave them back the equivalent of what people would put in some sleazy new crypto boutique currency. So everybody's they're holding the latest iteration of whatever it is we had before. I didn't go in on the second deal because it was just too much red tape and too much giving them all of my information. So that's how the game has been played, and people should understand that when Bitcoin itself falls, all the thousands of Bitcoin wannabes, the crypto offshoots, are going to become absolutely worthless.
Are we likely to see a few good years ahead for the mineral miners?
Well, there is that problem. They've certainly, the mining shares have certainly lagged the price of physical metal, gold and silver, and it's not just that. We've had a significant decrease in energy costs, which should all impact positively on mining companies. So when you combine those things and you see that the mining stocks haven't had any move anything like what we've seen in precious metals, it's kind of discouraging. Some people would say, well, investors just want to be really sure that gold and silver prices the high prices are here to stay before they take the plunge into the exploration stocks and the bigger mining companies. But I think it's not a bad place to put your money. Let's just say the value is definitely there. Some of these companies own the lots of proven reserves that are hugely undervalued. And even though I mentioned this earlier, but we've talked about it, the Mark Twain idea is that a gold mine is a hole in the ground owned by a liar. But most of the supposed liars I've met these were on trips to mining sites in Mexico and Canada and California, other places. They were organized by Al Corlin. So we used to go out to the mines, and the CEOs were generally mining engineers with a pretty good knowledge of what they had in the ground. They all had different methodologies, the exploration companies, with respect to how they locate the gold. It's almost like a divining rod thing where you get a little engineering and a little bit of spook magic involved. But I can remember one company in particular. It was a Nevada company that had leased a huge amount of land for mineral development in Nevada. And the CEO on one of these tours just he took his arm and he waved it across a wide swath of the Nevada landscape, and that was all silver rights owned by this company. And the company languished, and it never really recovered during the bad years before silver really started to firm up. So I think a lot of these mining companies represent some of the best untapped value in the investment world.
Have you been watching lithium and the critical minerals used in lithium-ion batteries?
Well, I think I'm not a big believer in lithium. I've been sort of sitting on shares in a lithium stock that was recommended to me by a friend who's got his own newsletter, and it's just gone nowhere. And over that time, I've been more susceptible to the bad story about lithium, how it really it makes an ugly mess of the landscape. It is environmentally difficult to mine, and there are some substitutes coming for lithium-ion batteries that are probably going to be a negative for the market. So I'm not a fan of the lithium story anymore.
Is Florida a hotbed for electric vehicles?
I don't know. I live down here, and I see a lot of Teslas and hybrids and all that, but I'm not sure how things look if you're in Wyoming or Texas or wherever. Well, actually, I've been in Texas, and I see a lot of Teslas there, but you see them everywhere. So I don't know. I think all states will be a hotbed for electric vehicles when they get the battery problem solved. And by that, I mean you get 1,000 miles on a charge and, let's say, a better lifespan, better ways of disposing of used batteries and things like that. But there are still considerable problems for the EV industry, which may have bottomed, really. There was maybe 2 years ago, you couldn't, all the negative stories were hitting at the same time, even the one about how you couldn't even tank up your batteries in the cold of Chicago, and it's only in places like Sweden where they sort of learned the workaround for that. So, and there was that story, and the price of used EVs hasn't really recovered. GM sold its entire fleet. That depressed the market for quite a while. There was a time when you could buy just about any used Tesla for the $25,000 price. The GM seems to have set a cap when they blew out their whole, not GM, I meant the Hertz fleet. So in any case, the resale value is also a problem. So it's going to take a while before EVs are going great guns again in Florida or anywhere else.
And of course, I think GM has taken, a $13 billion hit bailing out of the electric vehicle business, and Ford has found their electric F-150 truck also has been a bust.
Yeah, it's the automakers put a huge sum into it. They also put a huge sums into AI. Most of them have pulled out of that game too, but you have corresponding places where that the decreasing demand will be augmented. I just read that there's something about Caterpillar has big plans to make heavy machinery EV, and to take, in other words, we'll have some really big tractors that are electric powered. But and also, the robo fleet that Musk keeps telling us we're going to have, and I don't doubt him really. I mean, he's in a good position right now to put Uber and Lyft and Waymo, which operates in San Francisco and a couple other places, out of business almost overnight. But so anyway, there's still a lot to come there.
Rick, anything else we should be keeping a close eye on right now?
Well, all right. To sum up, there was the Dow at 50,000 and gold at 5,000. I have a not quite round number target for February gold. It is, I think, $5,134. So that's pretty specific, and I think there's someone mentioned in my chat room there was one notable forecaster who agreed with me concerning the target up just a little bit above 5,000. So keep your eye on bullion here and the Dow, and don't trust AI further than you could heave a cinder block.
Rick, thank you so much for being on This Week in Money.
My pleasure, Jim. I appreciate your inviting me on.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. Coming up, Josef Schachter, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Josef Schachter, founder of the Schachter Energy Report online at SchachterEnergyReport.ca. He's speaking to us from Calgary. Welcome back to This Week in Money.
Oh, a pleasure to be with you again, Jim. Always a pleasure.
How are things at the Schachter Energy Report, and how can our listeners subscribe?
Well, we've been very busy. This issue that came out on Thursday of the week was our opening report, which gives our fearless forecasts for 2026. And I think I've been talking low prices in Q1 and each quarter thereafter strengthening and a $70 average. And then we introduced coverage on a new company, so we're back to 32 companies and in terms of our coverage list, and it's a natural gas story, a very compelling one for the right investors. So people who are subscribers can read the reports. To get into our product, you just go to Schachter, SCHACHTER, EnergyReport.ca, and then you can see there's two subscriber levels, annual and then the quarterly, and you can see what's appropriate. You can also, when you go on the website, You can see some of our podcasts, and you can also see some previous research reports, so people can get a feel for what we do and see if it's of interest and benefit to them as investors in the energy sector.
You'll be speaking in Vancouver February 6th and 7th at the World Outlook Financial Conference. How can our listeners attend to see your presentation live?
Yeah, well, Michael Campbell does his Money Talks World Outlook Financial Conference. So go to moneytalks.ca, then go to where they say the World Outlook Financial Conference. On the website, they'll show the agenda, so you can see there's 12 energy companies speaking. I'm always asked by Grant Longhurst, who works with Michael, to open the doors to bring really good companies. And so 11 of the 12 I cover, and 11 of the 12 are on our recommended buy list. So they've got the best of the best from my group, and there's one new company there which I'm going to get to know, and then maybe I'll visit once we're back in Calgary. So it's going to be a great event. They have over 1,200 people there usually. It starts Friday around just after noon, and it goes all the way through Saturday in the early evening. So it's a great event. I think there's still tickets for the general tickets. They're premium tickets, I think, all where they have a breakfast on the Saturday morning and lunch on Saturday. The breakfast is the oil and gas side. The lunch is the mining side. Those tickets, I think, are all taken down. But the main hall, which holds 1,200 people, and then the breakout sessions to meet and listen to all the companies. And the big thing that's exciting, which we do at ours conference in October, is there's booths. And the companies are at their booths during the parts of the day. So if you want to talk to the president of Birchcliff or Surge or InPlay or Hemisphere, Total Energy, a big group of people, Bonterra, so you can then have time to talk to them one-on-one. And access to management is very valuable as an investor, because you can go there and say, you can look at the quarterly reports and you may not know stuff, and this way you can talk to the manager and look them in the eye, see how confident they are, see how happy and optimistic they are about their outlook in the years ahead, and that kind of will give you the comfort zone to own names for a multi-year bull market, which is what we believe will take place into 2030 or longer. And so, I'm looking for a correction during Q1. We got one last year, March, April, as you know. We sent out table-pounding buys, which worked out beautifully. And now I think we need a little bit of pause, a little cool-off, because the sector's done extremely well. And I think, if I'm right, that the price of oil goes from 59 down to 52, 54 during Q1 because of inventory builds in the United States. The Iran premium disappears, and I think that would be a great buy window. And we're going to inform our clients when it's a table-pounding buy again.
West Texas Intermediate crude seeing volatility around $60 a barrel. Does the crude oil market think the U.S. military is going to meet any real challengers as it dismantles evil regimes?
Well, the evil regimes and the geopolitics always affects the price of oil. And it's really the concern, for example, in the case of Iran, would there be sanctions where, they would not be allowed to, they're talking about a premium, 25% tariff already, President Trump. And then the question is, will China listen? Because they're the main buyer. And I don't think, they're going to say anything to the U.S. They're just going to keep on buying because they're getting discounted oil. It's the oil that goes in their refineries very well. And if they need to do convoys with their naval ships, they can do it. And the United States, so busy with Venezuela now with the aircraft carrier there, they've had to try to find a new aircraft carrier to go into the Med so they can be there near Iran. So the U.S. doesn't have the Navy to take on the Chinese Navy, and the distance for China's are much shorter than the logistic channels are for the U.S. at this point. So I think that, the Middle East countries, Saudi Arabia, Oman, Qatar, are all asking the U.S. not to do military action, let the, protests in the street continue, as long as the government doesn't shoot people. But if they, there's rumors, that the 2,500 deaths that people are talking about and 17,000 arrested, that there may be more than 12,000 that have been killed, and the data still can't come out of the country because the internet is shut down. Starlink is having problems because of the blockage from the Iranian security services. So it's a problem. So in the case of Venezuela, the Americans are going to handle the sale of the oil. They're going to get a better price than the government was getting before. They will hold the money with the government and allow certain expenditures, food, medicine, other things that are needed. But it's not going to go in the hands of the Maduro loyalists who have been raking in the money and grabbing the money and not investing it in PDVSA, the energy company, and not investing it in their economy. They've just been taking their narcotics profits and their oil profits and in gorging on the money, which it is now going to stop because I think the Americans have read the Riot Act to the new president. And the key problem is, that you've got the military and you've got the militias. And so the military has to decide, we don't want to have a fight with the Americans. And they then tell the militia to disarm, give them the guns, and that's what the new government's going to have to do. Once the militias are disarmed, then you can start looking towards free and fair elections, and the current government can run and the opposition can run, and with independent observers, you could probably have a free and fair election, and whoever wins would have the world's support. So it's a process, and it takes time. And then, the nationalized assets have to, by rule of law, be returned to the American companies before they're going to go in seriously. The only company operating right now is Chevron. They're producing and shipping to the United States 120,000 barrels a day of heavy crude, and they could probably double that. So there's going to be growth in 2026, but it's really going to be 2027 when you see lift once the nationalization reversal occurs and the American companies that were there, feel the rule of law is safe enough for them to operate, and then they bring in all the new technology. Halliburton has said, we'd love to come in there. Schlumberger, we'd love to come in there. So the service industry is ready to help out to repair the facilities. It just needs the rule of law for the American companies to feel comfortable spending, $10 billion a year for quite a few years.
How long do you think it could take to get Venezuelan crude shipping to the U.S.?
It's already happening. There was a press release yesterday. 1 million barrels came out, and it was sold at $50 U.S. So, right now, we're looking at $59 for WTI, but that's light oil. So there's a discount for heavy. The heavy oil discount, the WCS, Western Canadian Select, discount is probably around $14 Canadian. So you take, the price of 59 multiplied by 1.38 minus 15. That's the price the Canadian companies get. The differential, was bigger for Venezuela. I think they were selling oil in the mid-40s to China. Now they're going to have to be paying higher. So they got, if the $50 is the accurate number, they paid, $6 more than the prior cargoes. So the cheap Venezuelan oil is not there. The only place they can get cheap oil now is Iran. And then again, what happens with the uranium production? If the Americans do any attacks, they're going to go after the IRGC, which is the Revolutionary Guards that support the mullahs, or they could decide to take out the mullahs. There's a city called Qum, which is their religious, base, and they have IRGC assets there protecting them. Taking out the IRGC, ones protecting them is probably a good thing, and that would scare the mullahs to make the decision that they either, have to give power to the military, allow more freer and fairer elections, but they want to keep a theocratic, country where the Shiite religious order is the one for the country. the interesting thing is so many young people want the Shah's son to come in, the Prince Pahlavi, to come back, and he's been on TV in the United States like crazy. You almost turn on the TV, you see him on different shows, and he is saying that he would like to be the head of an interim government. Should they depose? And there's so many Iranians out of the country who left or were chased away, who could come back and be the government. So and then the transition would occur. Does he want to come back and be in government? Who knows? Some people are speculating he may want to have the Shah regime come back with him going from prince to Shah. So there's so many wild things coming out of it. You don't know what to believe, but you do know that the 3.3 million barrels that Iran exports has a buyer, and they're called China.
The geopolitical map looks like it could be in for some big changes. Is this likely to cause more volatility in the price of crude going forward?
Yeah, well, we've got Venezuela taken care of, so you don't have to worry about volatility there. The Americans are going to make sure the oil gets produced and then hopefully entice American companies more than Chevron to raise production so there's more money to help the economy and move it to democracy. Iran, with China being the buyer and making sure that and warning the U.S. not to attack any of the oil facilities, which are not, they're guarded some part by the military, but the key is that they don't have any major export facilities destroyed, which I don't think will happen. Even Israel won't do that. Because once there's a regime change, they need the economy to make money and be able to take care of their people. So their biggest revenue source for them is the energy side. Then going to Taiwan, that could be an interesting one to keep an eye on, because if China gets aggressive with a blockade on Taiwan to force them to have a new election to join China. They pressured the Portuguese and they got back Macau. They pressured the Brits and they got back, Hong Kong. They've still got, and they've got a bigger navy than the U.S. right now, and the distance from China to Taiwan is pretty short. So the logistics for the military are pretty short, and that's why I think Taiwan is arming itself to the teeth so that it's not a rollover, but we'll have to. Chinese aircraft that were sold to Pakistan took down Indian aircraft that were using U.S. Equipment, and so we'll see, how China can fare, and are they serious enough to want to blockade Taiwan, and that's still up in the air. But I think that the successful blockade by the U.S. on Venezuela could be something that China is looking to.
Prime Minister Carney was in China this week talking about Canada and Communist China being strategic partners, including on issues of security, and then he invokes the New World Order. Could these announcements, along with Carney's connections to the World Economic Forum and the Chinese Communist Party, end up being an anvil on Canada's oil and gas industry?
Well, let's start with the deal. Carney's calling it a landmark trade deal. There's a lot of articles coming out, and people can turn on CBC, CTV, and just get it. The deal is effectively, if they wanted to get canola, which was facing 100% tax rate, or tariff rate, to go down, I think it's 15% tariff or less, they had to agree to allow Chinese EVs to come into the country. Immediately, they'll be allowed, starting, I think, April or so, March, April, and at the same time, canola will get, and lobster and crabs and peas from March on would get the lower tariff going into the country. But they can sell 49,000, but within a few years, I'm not sure if it's 4 or 5, they can bring in 70,000 cars. The auto tariffs is going from 100% that we had to 6.1, which is a favorable auto tariff rate. And in 5 years, that number goes to 70,000, and 50% of those cars have to be priced under 33,000 Canadian, which would be a very low point, and they would be the basic EV cars. But China, they've become so efficient and lowered the cost so much, and you could get a pretty nice car at 33,000, and it'll be interesting to see if BYD comes in or NIO. There's so many companies there, so I think that's going to be something. So Premier Scott Moe from Saskatchewan is very, very happy about it. Premier Doug Ford, he's saying is critical of the EV deal, warning that China now has a foothold in the Canadian market and will use it at the expense of Canadian workers and the Canadian auto industry, which of course is heartland is Ontario. Going to the other questions you had about this, he's going to the World Economic Order. I think he's going to in Switzerland, Davos, and then he's got some other places he's going on this world trip that he's doing. I don't think the World Economic Order has got the new really has much. The World Economic Forum just doesn't have any power anymore, and I think it's just a nice party for the CEOs and those who believe in globalism, those who believe in one national government. It's a boondoggle for them. There's no way the countries are willing to give up their sovereignty. The Americans for sure. China wouldn't. Russia wouldn't. So these are just a cluster of people who have a narrow view of the world, their view, and they're trying to propagate it. They sure didn't do well with their environmental concerns, and of course they wanted to get rid of natural gas, and they wanted wind and power, and now it's pretty clear that wind and power have problems, being on all the time, and storage of the power is an issue. So I think it's pretty clear that the natural gas is the interim fuel, but a lot of countries, are still using coal. China's still building coal plants, coal-fired power plants. India is doing the same. So the whole gamut of views that they had to get away from fossil fuels, they've lost that one for sure. Questions about Carney's connection to the Chinese Communist Party. I don't know if there is anything like that. I think more he tried with his minions to find a way to get canola and like agricultural products and fish products that were harming the East Coast lobster and crab industries, Saskatchewan's canola industry, and the cost was a small 3% market share for China's EVs.
Canada is a very resource-rich country with a political class that doesn't want to allow the people of the country to prosper by extracting resources. Do you think this is on President Trump's radar, and is there a case for Canada experiencing significant prosperity by becoming the 51st state or being annexed by President Trump?
Well, I think we know for sure we're a resource-rich country. Canola. We know wheat. That we have uranium. We have fertilizer. We have the oil and gas industry. There's so many mining. Be it copper, nickel, precious metals. So we are a resource country, and the government, Carney's government, is saying they're going to start, speeding up the approval process. But a 2-year approval process is garbage. You got to be making the decision to be, projects should be approved in 6 months. And so, the process, while heading in the right direction, the speed of it, I think, is disgusting. And I fault the government for doing that. Is there a case for Canada being part of the 51st state or being annexed? Look, he's not going to get Greenland. You've already got Denmark sending troops over and NATO and Europe sending troops to protect the country. Greenlanders don't want to be there. I don't think Trump is going to invade. He says that he needs it for the dome, to give the protection to the continent. But I don't think that that's going to happen. His dome is going to be so filthy expensive that if he if he loses the midterms in 2026 and the House gets controlled by the Democrats again, which is what the prognosticators are calling for, because normally the interim year the party in power usually loses 20 to 30 seats. Well, there's only, a 17-seat majority or a 7-seat majority? I don't even remember the numbers, but it's a small majority. And so if he loses the control of the House, it's sure going to make any, potential moves by Trump to be, it'll be tougher, and maybe even anything that the power of the purse is needed, the House can say no, and that's the end of it.
The U.S. military, in a precision operation, extracted unelected Venezuelan President Nicolas Maduro and his wife with 0 American casualties. Other countries brag they have big militaries. Do you think any countries are likely to take on the U.S. military?
Well, there's always these, terrorist nations like, the Houthis in Yemen, that are going to, and the ISIS, which has, they were in Venezuela. Hamas and Hezbollah and ISIS were in there. That's one of the things the Americans want the new government to clean out. You've got ISIS in Asia. The only country that really, has the power to challenge, I don't know if they want to go in all-out war, but to challenge the Americans. Like the Americans say, the Western Hemisphere is theirs. And the Monroe Doctrine, or now they're calling it the Donroe Doctrine, after the Donald. But China, like America wants control of everything in North America, Central America, and South America. China is saying, look, the South China Sea is theirs. So the waters around where they are in Taiwan and Philippines and Vietnam, they're saying this is our backyard. And so the Americans are trying to build bases and joint ventures with countries to challenge and keep China, within its current borders. If it's good for America, why can't it be good for China? They've got an economy that's closing in as big as the United States. They have a population that's at least 3 times bigger. They have a navy that's bigger. So China would be the only one. But an all-out war I don't see. I think it's just Taiwan is in play at some point, and the Americans just have to decide, can they go and defend it or fight back? And I don't think I think all the war games that people talk about have said China wins.
What's the latest on rig data?
Yeah, it came out this morning, and the U.S. rig count went down by 1 to 543 from 580, so it's down 6.4%. Canada, because we got out of the holiday period, the rigs were down to low numbers. It went up another 29 this week. Last week was a big number, but it's still down from it's 226 down from 229, down 1.3%. When you break down the data between the oil and gas, the gas side in the States, because of all these new LNG plants, is 122 rigs, down 2, but on the week, but up from 98 a year ago, up 24.4%. The oil rig count was 410, up 1, but it's still down from 478, so it's down 14.2%. In Canada, the rig count went up 7 for gas and 22 for oil, so the numbers comparison year over year, up 4.1 for gas. Again, LNG Canada, and it's going to hopefully go from 1 to 2 BCF in the coming months. And oil up 22, but that's still down 3.8%. And again, the commodity price is the issue there.
What are you seeing now for a bullish case and a bearish case for crude as we move forward into the new year?
Well, if you're saying, where will we be at the end of 2026, I'm looking for a little bit of a correction in Q1 because of inventory builds in the U.S., and that I think is going to pull the price down. And then if the Iran war drums, dissipates and people see that Iran's still able to sell to China, I think the price backs off to 52 to 54. We were at 55 or 56 just 2 weeks ago. So run up to 61 on the Iranian scare, back down to 59. I think we were looking at 52 to 54. Going to the end of the year, I'm looking for over $70, over 75 probably. And so I think, each quarter will get better and better. So I think people should be, optimistic. So the way I'm looking at it is the bullish case is that demand grows in 2026 by 1.2 to 1.3 million barrels per day, and that's the same as we had in 2025. Most of the demand comes from the Asian areas, be it China, all of the Southeast Asia areas, and so we expect that to continue. And so that demand increase will and the fact that OPEC has not been able to increase production. They had a small increase on the OPEC side, but the OPEC Plus side was because of problems with two major countries there. It was down. Almost 300,000, 344. So I can give you the numbers. The number was up 105 from the OPEC direct to 28.6 million. The big increase came from Iraq. They added 55,000, and Saudi added 27 only. But there was a 60,000 decline in Venezuela, so the net was 105. The net from the rest of the OPEC Plus world, the big problem was Kazakhstan down 237, and then Russia down 73, and that's because the ports in the Black Sea have been attacked by Ukrainian drones, and so the shipping has stopped, and so you can't load crude carriers from Russian side of Black Sea and move them, and the one that gets hurt the most was Kazakhstan. So the non-OPEC, the OPEC plus, the OPEC plus people outside of OPEC had a decline of 344,000. So the overall was a decline of 238. So when people start seeing that OPEC really doesn't have the ability to grow production, and if the growth in production outside of OPEC plus is only about 600,000, so once you have the 1.2, 1.3 in the books, that's going to drive inventories down. Global inventories are 88, 89 days for the OECD, right where they should be. There's no glut there. U.S. numbers are at the low end of the 5-year band. The on the sea is really where it is. But with Venezuela's shadow fleet now controlled by the U.S., I don't see the bear case. So what could be the bear case? The bear case could be if we see recession around the world. The bear case could be if Venezuela starts talking about raising production quicker and more inventory comes on, which balances the 1.2, 1.3. You have 600 of new production. Canada, Brazil, Argentina, U.S. And then if you have 600,000 more coming out of Venezuela, that would be bearish. Iran, if things settle down there. If Russia and Ukraine, the war ends and Russia's able to get out of sanctions and raise production again. So there are negatives out there, but it means peace in our time. And, of course, you've heard President Trump saying he wants $50 WTI. The problem is the industry in the States needs in the mid-60s to justify drilling. So there's a conflict there between the president's desire and the company's need for a profit to justify spending. That's why I believe the longer this drags out with these low prices in Q1, that's going to set the stage for much higher prices later in the year. And people need to just pull out an oil and gas chart and see where the price of oil was in 2024, 2023, and 2022, and they'll see $80 and $90 numbers. So when we have a rational market and people see that inventories are normal, that Saudi Arabia and others in OPEC can't raise production, that's going to be a positive. So the bear case is peace in our time everywhere and more production coming on from the sanctioned countries. I don't see that happening in 2026.
How about a bullish case and a bearish case for natural gas?
Well, the bullish case is that people decide they're going to use less coal, demand growth in the countries that are bringing on nickel, copper, lithium, cobalt, all the rare earths, they're going to use more energy, and that energy is likely to be crude oil. And for domestic consumption, like the countries there, they would probably be using natural gas, and for natural gas for power to build those facilities, and for the people working there will want in their houses power and water, and so that's going to be a big issue there. The bearish case for natural gas is weaker economies. If the price gets up too high, then coal becomes, when you get to $5, U.S. coal is more economic than U.S. natural gas. NYMEX needs to stay under 5 in the 4 or 5 range. And so that becomes part of the bearish case for natural gas in terms of growth of demand is that. The other one is if more and more LNG plants get approved and money is there to build them, you could end up with a somewhat glut of LNG. You're looking in Europe and Asia between $10 and $12 US. Minus out the transportation, probably means a $6 price at the LNG plant, and so that's so it's profitable to ship it. But if there's more LNG plants and there's more competition, you could see that 10 become 8, and then you minus out transportation and the cooling, refrigeration. Then all of a sudden the LNG plants don't make a lot of money. So there's a bullish and bearish case there.
Could artificial intelligence help in the exploration and extraction of oil and gas?
Yeah, I did check that one out, and when I saw that you wanted to chat about it, and the AI is helping. When companies drill, they have now tools that can see where they're drilling. Are they in the zone? Are they getting the best? If there's let's say a 10-meter zone, are they in the 5th meter so that they can get the maximum between the high and the low? In terms of the drilling, to speed up the drilling, and the AI is helping to make sure they're as efficient as possible, both with manpower and with the rig. And then when you're producing the oil, AI can be used to say how much do you draw down, how much do you put in of fluids to help move the product in the ground up to the surface. AI can be used for the pumps, the pump jacks you see everywhere, to make them run smoother and quicker, to pump out more oil. And then water floods or polymer floods. AI technology can help there to tell you how quickly you're going to get a response. So, I think AI in the operating field for the oil and gas industry is going to be very, very important.
Is the wider spread use of lithium-ion batteries starting to slow the demand for oil?
Look, in Canada and the States, EVs, are not working. GM's taking big losses, Ford's taking big losses to close them because people just haven't responded. Be it the charge, be it lack of charging stations, be it that people like their trucks and EV trucks just didn't get a market. People want the power of gasoline and diesel. So I don't think that there's a good argument anymore for saying that we're going to see a problem with lithium-ion batteries. I think it's going to be a longer cell cycle, and you're going to need to bring the prices down. Auto prices have gone up insane because when you had COVID, then when you had the issue of lack of chips, because the factories were not around, the industry decided, we're going to do the high end. We're not going to do cheap trucks. You remember trucks 10 years ago? You could have a reasonable truck with with a deck on the back, and it would be cheaper than a car. Now everything seems to be $100,000, and they're loaded to the gills.
Gold and silver continue to hit new highs. Do these high precious metal prices affect the oil market?
I think the issue with the precious metals is, number one, central bank demand, because they're losing confidence in the U.S. dollar and U.S. Treasuries. China doesn't want to own U.S. Treasuries. They're selling theirs down, and they're buying gold. Russia doesn't want to have U.S. Treasuries. Japan has its own problems, so they're selling U.S. Treasuries. The U.S. Treasury needs more money every year because of the deficits and the renewals. And the U.S. bond market is so much as in the corporate world is raising the trillions of dollars needed for bond financings. A lot of that related to building data centers. So I think that the energy side is not affected by it. And gold and silver is a store of value, and people like it as a store of value. And so I think, precious metals, could we see 10,000 gold before the end of the decade? Probably. $200 silver. I was talking to a silver analyst, this week, and, he thinks we'll see $200 silver because the demand is also being used in technology. And so, in chips and other technology. So, and China loves silver. So, you're going to probably, and the industry is not producing enough to meet demand. Same argument you can argue for copper. Other, so many commodities now, uranium, the physical demand is greater than physical supply, and that justifies means for higher and higher prices. And I think that's going to happen to oil. I think in the second half of 26, people will see that new oil production is not coming on. Remember, you got to take into account depletion. Now, some people say depletion is 5%, some say it's 8%, but let's take 5% on 105 million barrels of consumption in 25 and 106.4 in 2026. You're talking you need, potentially, 6 million barrels of new production coming on every year, and we're not even bringing on half that. So the reserve life indices are coming down, and that sets up the story for a very, very bullish energy sector in the years ahead. And that's why I say to people, while I think there's a correction, don't sell your names, but be ready to buy on the next phase of weakness. And we got a great buy signal in March, April of 25. I think we're going to get another one during, March or so of 2026. We'll send out buy signals to subscribers, recommend some great new ideas, and reiterate those that we cover that are at bargain levels. And then, if we get to $70, $75 oil, then people, number one, cash flows will go up because of the higher commodity price. Companies that had debt will be able to pay it down, and that'll increase shareholder value. And then, if the NAVs are done at the end of 26, you use a higher price than the price decks at the end of 2025, and the price decks at the end of 26 are much higher. That adds to NAV, and that's going to have the stock market react very, very positively.
Dr. Copper over $6 US a pound this week. Is that an indicator of what might be ahead?
I think it's supply and demand, as we talked about with other commodities. And the reality is, to bring on a new copper mine, you've got to do it in the third world. Electricity, roads, providing good jobs for people, training them, building the communities where there's going to be good housing and schools, electricity, water. To put on a copper mine, let's say you make a big discovery today, it may take you 3 to 5 years to bring it on. So Dr. Copper is just showing that it's needed for data centers, and people are just chasing it. It's like, you look what's going on with the AI stocks and the semi stocks. The demand is so strong, and the pricing power they have to raise prices. Some memory chips that used to be $50 are now $2,000. So it's just nuts. And I think there's over ordering there. And I think also that you can't build the power plants fast enough because you don't want the grid. You don't want to be taking from the grid. And so you're seeing Meta and IBM and others saying that they're going to build their own power to generate Amazon the same. The problem is if any of them take from the grid, that means higher prices for individual individual consumers, and that politically is going to be a big problem. And utilities already in the Northeast are facing that challenge because they sold the discounted prices on long terms to the data centers to get them to come and have the jobs there. And I think the data centers ripped off the public utilities there, and those utilities are going to be charging, high rates to the individuals and normal businesses, and the cheap deal has gone to the data centers, and I think politically that's going to be not acceptable, and there's going to be a massive backlash to it.
Stock markets continue to hit new highs. Are you bullish on the stock markets?
No, I think there's, the valuations are at excessive levels, more than 2020, more than 2008. You can argue that there's a reason because of data centers and the wealth effect and stuff. But I think that, when you get to an overvalued, there's a pendulum, and it can swing from excessive optimism to fear. I think we're looking at some point in the first half of 2026 that we're going to see a pullback in the markets. It could be 15%, it could be 20%, I don't know, but it'll matter. Is there going to be trouble raising money for the U.S. Treasury for the deficits and the renewals? Right now, the high for most recent months was on the 10-year was 4.21%. I think we're around 4.15 now. If we go over 4.21 and there's a crowding out of other borrowers and interest rates go to 4.5 or more, that's going to be a negative because the way they create multiples and targets for the AI stocks is based on low interest rates. Interest rates go the other way. They become competitive, and investors decide maybe I should have more bonds versus keep on chasing the high flyers. And that would be a big problem for the stock markets.
Could housing market troubles spell deflation ahead?
Well, the deflation would be, in the, wood and wallboard and, concrete maybe. And, there would be, higher unemployment from those working in that industry. The prices of housing have gone up so much, and it's unaffordable for young people. You've seen articles in the paper where families are now got 3 generations in the same house because the younger ones don't have the ability for a down payment. And in the States, the prices have gone up so much that, there's articles I read that 50 to 60% of the U.S. Are now renters versus 20 or 30% because the cost of buying a home is just out of sight. And the people who are wealthy, the 20% at the top end of the wealth spectrum, they're the ones buying the big monster homes. But if there was a pullback in the stock markets and their wealth, they start feeling challenged by their wealth coming down, and maybe that's going to help to pull back real estate prices at the high end too.
Bitcoin showing some strength other than money laundering. Are there any uses for Bitcoin?
Again, some people see it as a store of value because they like it that it's not controlled by central banks or any government, and they see that as a way to move money around with getting around the reporting purposes to the U.S. Treasury or the Bank of Canada or the the CRA, and so people will like to do Bitcoin because it's not traceable. It was down in the 80,000 something a month or two ago. It's up 97 or 98 now thousand, but it's down from 120 at the high a year ago. I'm in the camp that if there's going to be a correction in the general market, those who are speculators who own Bitcoin on margin will get margin calls, and that would mean a pretty significant correction in Bitcoin. But I don't know enough about it, in terms of supply and demand factors. One of the things, of course, is many of the supporters of Bitcoin are trying to get the U.S. regulations changed to make it easier for individuals and companies to buy it, and then have the major brokerage houses in the States able to trade it for their clients. So we'll see. I wouldn't own Bitcoin personally.
Canadian dollar's been pulling back. Would it be fair to now call it the Carney dollar?
Well, I think the price of oil matters. I think the trade issues are going to matter. If we don't get a trade deal with the United States, we're going down. If the price of oil goes down to the low 50s, we're going down. So I think there's a chance we bust below 70 in the first quarter of the year. And I don't know, what are we today, 72 cents on the Canadian dollar? So I think there's lower prices ahead in the near term. But if we get $70 or $80 oil, or 70 plus into $80 by the end of 2026 and early 27, that's going to strengthen the dollar because the value of our energy exports to the States will still occur. And that's one of the biggest positives to our trade balance is our energy exports. So if we have the same energy exports as we have now, but we also have much higher prices, that means a better trade surplus, which means a stronger Canadian dollar.
Alberta independence is heating up one way or another. Is independence likely to be rigged to ensure failure?
Right now, you don't have our premier or any of the government people interested in it. It's a fringe group, and they're just so pissed off with Ottawa and the Liberals and stuff. I don't think that even if they got enough votes or people to ask for a ballot, I don't think it's going to it's not going to be 51-49 that was the last vote in Quebec about separatism, and we now know the PQ is probably going to win the next election, and they've said they plan in their first mandate to have a vote on it again, and they're going to push it. But I think the only way Alberta and Saskatchewan decide for independence is if there's no good response from Ottawa, and I think that's why Scott Moe, the Premier of Saskatchewan, was on the trip with Carney, and the canola became important because they need to find new markets. China, they're trying to get, Carney wants to get China trade up by 50%, but it sure is nowhere near the trade we do for the States. So, the more he pisses off or annoys Trump, the longer it's going to take for us to get a tariff deal with our main trading partner. So I don't know the logic of what's going on. I think it's maybe to show the Americans that Canada is going to be somewhat independent and that they need to come up with a fair deal rather than a mandated deal by U.S. interests. So, again, this is all stuff at a level that you and I as regular citizens don't know what really is Carney's goal. But the bottom line is, I don't think in the next couple of years that a vote and a serious intent to leave and become independent is likely.
Are Aboriginal land claims causing oil and gas exploration to slow and big money to leave Canada?
The Aboriginal land claims require then that you get a deal with them if you want to drill. So it's impacting drilling in areas where the Aborigines are not prepared to give land for and drilling opportunities in return jobs and royalties. So that's the basic there. Big money leaving Canada. I'm hearing more and more it's the reverse. I think the fact that we do have coastal gas, the fact that we do have LNG Canada up, the fact that we have oil resources. So TMX I think will be full by the end of this year. As Asia says, we need to, we're not so sure we want to buy so much U.S. oil. Maybe we'll buy Canadian heavies, especially, when you have the refineries able to do it and the transportation distance from Venezuela, which is now going to be world prices. It's cheaper to ship from Canada. So I think that we will at some point attract. Remember, Ovintiv came in and bought New Vista recently. They did a big deal with Paramount. So the Americans are coming back into Canada. I think we'll see some of the big European countries at some point think about doing the same.
Where can our listeners follow you and subscribe to the Schachter Energy Report?
Well, I go to SchachterEnergyReport.ca, as we mentioned at the start. We have two products, Ion Energy, which is part of the full SCR part. But if you're only interested in macro, on Substack is where you can find the Schachter Ion Energy Report, and that gives you the macro information. If you want the macro and if you want the company-specific research, 32 companies, and we're planning to increase that by 2 or 3 more in the first half of 2026 because we have some great ideas and we want to spend time with management, write up our reports, just like we did on the one that's out in the Thursday report. So again, just go to our website, Look at the previous reports. Look at the listen to the podcast, and then just like this one, like you and I are doing today, and you can decide what fits your pistol. There's some great yields out there. People don't realize how attractive the industry is even today. You've got 7% royalties in a name like Freehold. You got a 5% yield in Topaz Energy. You got a 6.6 in Whitecap Resources. Marin Energy, 11% dividend yield. Surge Energy and a 7.8 yield. Alvo Petro, 8.7. Hemisphere, 5.2. But with the special dividends, that gets you to set 8%. You've got In-Play Oil with 8.8. Petrus at 6.6. So there's a lot of companies with great yields that we cover, and people should be who want dividend income. The ideas we have on our list will provide you with some great ideas.
Thanks again, Joseph.
My pleasure, buddy.
My guest has been Josef Schachter. He was speaking to us from Calgary. Coming up, Robert Campbell, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Robert Campbell, publisher of the Campbell Real Estate Timing Letter, his website, realestatetiming.com. He's speaking to us from San Diego. Welcome back to This Week in Money.
Thank you, Jimmy.
Bob, you say we're in an accelerating phase of an inflate or die policy for the U.S. economy. Why is that, and what is it?
What it is this, is that the U.S. economy has to continue inflating, spending money they don't have to keep the wheels on the economy. And to keep the wheels on the economy so it doesn't go into a severe and prolonged downturn. Right now, during the pandemic, the U.S. government started experiencing spending $2 to $3 trillion a year more than they took in tax revenue. And that was because of the hard times. They shut down. They shut down businesses, and people couldn't work. And so there was some reasoning for that. To keep the economy from crashing, the government started compensating for the loss of consumption by spending money they didn't have. Okay, so now we're past all that. The U.S. economy is still running $2 to $3 trillion deficits. Why? Because they have to. Because the national debt has gotten so high, and if they were to pull that demand out of the U.S. economy with the debt levels that we have right now, the economy would go into a really, really bad tailspin. And so they can't do it. Because if you look at what's going on, there's been inflation since at least 1971 in the United States. That's when Nixon took us off the gold standard, and we stopped redeeming U.S. dollars for gold, and so the government could just print money, as much money as they want, and the inflation rate could go up, and people that held those dollars, even though they were depreciating rather rapidly, couldn't turn them in for gold. Since then, it's been nothing but inflation in the United States, and that's why they have to keep inflating right now. To even worse than ever because of the amount of the debt service that we have, and to keep things rolling. They can't stop, and so it's a train that isn't going to stop, guys. This train is rolling. The U.S. deficit train is rolling, and nothing's going to stop it. They can't. People say, "Oh yeah, we're going to start running a balanced budget." No, we're not. We're not. It's just not going to happen. And so we're kind of on a trajectory with some kind of financial disaster. And that's one of the reasons why there's two classes of people in the United States nowadays. People that own assets like real estate, stocks, gold, that all benefit from rising inflation. And the other class of people that represents about 80%, they're working for wages, and they aren't even coming up. They aren't even holding their own. They're getting worse and worse and worse because you can't get ahead in life just working for wages, especially in an inflationary economy. And President Trump's going, he's dissing this idea about affordability, and he's 100% wrong. He goes, oh, this is a Democratic thing, you know. No, it isn't a Democratic thing. Inflation, by the way, you guys, it's not 2.7% what the government reports. Add 4 or 5 percentage points to that number, and you're probably close to the real number. Because I know what healthcare has gone up, 15% a year. You know, insurance, home insurance has gone up 15%, per year. Everything's going up way more than 2.7% a year. That's just a fake artificial number. And so that's why the average American is struggling. Right now the stock market's at all-time record highs. Okay, who owns the stock market? The 1% richest people in the world own 50% of the stock market. Okay, that's pretty concentrated wealth. Okay, let's say the 90% of the stock market. The top 10% richest Americans own it. What's everybody else own? Nothing. They don't own anything, and that's one of the reasons why they're struggling so bad. The Michigan Consumer Confidence Index came out. The latest release showed that consumer confidence in the United States is at a record low since they've been tracking it. Record low. Where's the stock market? At record highs. We've never seen a diversity like that before. And so, and what it tells you is that, that you can say what you want, like everybody's doing well because the stock market's doing well. That's not true. Because if all these people are polled, and it's a fairly good sampling, the university index has been around for quite a while, and I don't think it's political, but it shows the average American is struggling. And that's because of inflation. And they got to keep inflation going. Because if they stopped inflation, even the people the unemployment rate would go shooting up, the economy would go into a tailspin, and they can't allow that to happen.
Why has gold soared to a new record high of $4,600 per ounce?
That's one of my favorite subjects. Gold is going to that number because the U.S. is out of control in their spending. They're spending $2 to $3 trillion a year that they don't have, and it's the debt to GDP ratio in the United States. The latest number was 121%, which is the upper limit of the danger zone. If you read the book, It's Different This Time, and he did a historical research. Economies around the world back for the last 200-300 years, when their debt to GDP ratio gets that high, it's a disaster. It's no different than a human being getting in overfinanced where they owe too much debt and they can't even afford the interest payments on it. Which brings me to another subject: the fact that if the government reported inflation what it really is, and I'm saying again to reiterate, 4 or 5 percentage points more than what they actually report, government bonds would be selling at 10% interest, not sub 5% as they are right now. Right now, the U.S. government is running a $1.25 trillion a year. $1.25 trillion a year is needed to finance the $39 trillion worth of national debt. If the government were to report inflation accurately, those 30-year T-bonds wouldn't be trading at 5% interest, 5% yield. They would be trading at a 10% yield. And that 10% yield right there, all of a sudden, the financing the U.S. debt wouldn't be $1.25 trillion per year. It would be $2.5 trillion a year. And another reason they can't allow that to happen and to report the inflation accurately is the Social Security system in the United States is funded 100% by U.S. Treasuries. 100%. Now, so if all of a sudden the yield on those Treasury bonds went from 30-year bonds went from 5% to 10%, the price of those bonds would be severely cut. Let's just say it's cut in half. So all of a sudden now Social Security can't even sell the bonds to make the Social Security payments to the American retirees who've had those benefits promised to them. So now you get into a situation where the U.S. government has to start printing money to cover what's owed to people that retire on Social Security. That's why it's inflate or die. They've gotten themselves into a deep... Once you get yourself into a deep financial debt hole like this, whether it's an individual or a state or a city or a government, there's no getting out of it, guys. Because debt is a real thing. And it has to be paid, regardless. And I'm not saying what the exact timing of this is going to be, but we are definitely going in the wrong direction. And the people in the United States are feeling it far more severely than that the people that run the government, want to let you know.
Why is silver priced at over $92 per ounce? Is this move speculative, or is there another reason?
There's another reason. In the past, we had silver back in 1980, 1981, spike up to $50 an ounce, and then came crashing down. That was based on speculation. And a lot of people are saying, this is speculative. You watch, silver's going to come crashing back down just like it did then. No, it's not. What's different today than it was then is, based on reports, the U.S. silver market has been manipulated by people in finance and the U.S. government for 30, 40 years, forever. Now, all of a sudden, the price of silver, the demand for silver is so strong because of AI, solar panels, cars. The demand for silver is 10 times greater than the supply. And that's a fact. So they can't suppress the price anymore. So now all of a sudden it's shot up. How much has silver gone up in the last 12 months? 130, 140%? That's not speculation. There's a shortage. And so it's selling at $90 an ounce here in the United States, which shows it's still being suppressed. You know what it's selling for in China? 130. So you can buy your silver here in the United States for $90 an ounce, let's say, and put it in a boat and send it over to Shanghai and sell it for $130, and that's a huge spread, and that gap is going to close. Silver is going to keep going up and up and up, and it's all because of demand, and the supplies are so low. And I don't study that end of it, but the people I rely on say, oh yeah, there's 10 times more demand than there is supply. That's why it's doing this. My God, it's going up. It's been going up $5 a day, and doesn't slow down. The government's tried to stop it by raising margin requirements. You watch, guys. The COMEX in Chicago, it's about to go broke because for all these contracts that are out there that are traded every day. And there's something like whatever number of contracts. Just for sake of example, let's say that there's 10,000 contracts, and I believe each one of those contracts is worth 5,000 or 10,000 ounces of silver. Does the COMEX have that silver in reserve? No. What percent do they have in reserve? 5%. So all those people in the United States that need silver, and used to be COMEX was a hedging device for commercial users to hedge their price. Now the people that have a contract there, if they all stepped up to the plate and said, okay, we're not going to roll our contract over because we're a commercial user. We want to turn in our contract and get supply, 5,000 or 10,000 or whatever the number it is per contract. The COMEX doesn't have it. Doesn't even close to have it. They'd have to close their doors and go bankrupt. And that's what I expect is going to happen. So we're in some really exciting times, guys, that all of a sudden, who would have known that the price of silver had been suppressed so long, and because of the demand for silver, because of, commercial users would all of a sudden shoot up, and they don't have the supply. So it's going to go to a big number, guys. A huge number. So this isn't speculation. I mean, that's a train that's not going to stop either. And I don't know where the ultimate price is going to be. I mean, it's in my view, 120 is almost a lock, a sure thing.
Where are mortgage rates and where are they headed in the U.S., higher or lower from current levels?
Well, they're headed lower. And I said, even though inflation is higher, the United States, the 30-year mortgage, fixed mortgage, trades off the 10-year treasury note. Okay, that's suppressed down to like 4% or something like that. And typically the spread between the 10-year and 30-year mortgages is like 2%. So add 2% to 4%, and I'm just throwing these numbers out kind of as an example. Now you have 6%. So that's where we are, the 6% right now. And they've been falling. Why have they been falling? Because the Fed reversed course in the last 30 days from QT, which is quantitative tightening, where they're buying where they're selling treasury bonds into the market because their balance sheet is something, they have like, what, $6, $7, $8 trillion of these things that they bought to suppress interest rates. Now they tried to sell them back into the market to get rid of them. Now they've got to start buying them again to keep interest rates low. Why do they have to keep interest rates low? Because we owe $38 trillion in debt, and we're already up to $1.25 trillion in debt servicing. So if you let those things go higher, it's going to go $1.5 trillion, $1 3/4 trillion. So and of course President Trump is urging that. He knows the situation, or at least I hope he knows the situation, that if you don't get interest rates down, this debt servicing is going to get even more out of hand, which is going to make things even worse. The U.S. dollar, even though the U.S. dollar index is kind of a fake index, because people go, oh yeah, the U.S. dollar is like the best looking horse in the glue factory. Okay, yeah. What is the U.S. dollar index compared against? Other fiat currencies. Are those fiat currencies like that? Do they have any real value? No, they're all backed by nothing. So what's really happening to the U.S. dollar, the purchase power of the dollar, is basically being measured in the form of assets. One of which is gold, the stock market, real estate. People need to have something that's physical and not just a piece of paper.
Would lower mortgage rates revive the housing market?
No, that's an urban myth, and it's perpetuated by the associations that are associated with real estate sales, like the California Association of Realtors, National Association of Realtors, American Home Builders Association, Mortgage Brokers of America. They want to tell you, oh yeah, get on board the appreciation train, because soon as interest rates start coming down, prices are going to start appreciating again. No, they're not. And they know they're not, because if you just look back over time, that you look and say, okay, back when housing prices, for example, let's use the most recent example of a bubble, when prices peaked in the United States in 2006, and they hit bottom 6 years later in 2012. What happened to mortgage rates during that period of time when housing prices fell nationally 35%? In California, they fell 50%. What happened to mortgage rates? They went down 3 percentage points. Down, not up. Well, how come housing prices didn't go up? Because the reason prices started coming down was affordability, extreme levels of the danger zone. Affordability in California hit 12%. Nationally, it hit some number that was like the highest on record at the time. And when you can't afford something, you can't buy it. So now all of a sudden there's more supply than demand, and down came housing prices. Yeah, will lower mortgage rates help lower mortgage payments? A little. Is it going to account for the fact that like in California, only 1 in 15 of the average adult households can afford a house? No, it's not even going to come close. During our last downturn in California, in 2006, housing affordability hit 12%. 12%. Only 12% of all Californians could buy. What happened to housing thereafter the next 6 years? It fell over 50%. What happened to affordability? It went from 12% to over 50%, guys. and then all of a sudden now everybody can afford a house. Things start getting rebalanced in the economy. All of a sudden now all of a sudden with housing prices cut 50%, now people can afford a house. And who doesn't want a house? Everybody wants a house, so they start buying, and all of a sudden that turns the trend from down to up, and now you're in a new recovery. So that's what lower interest rates isn't going to help at all.
Where are we in real estate? Is there an 18-year real estate cycle?
Yeah, I'm working on that right now, guys. I'm about finished with my January 2026 timing letter, and it's really interesting. Back in the 1970s, I bought a book from Edward Dewey called Cycles, How They Predict the Future. And what caught my eye the most, because I'm a real estate guy, was the 18-year real estate cycle. And it worked like a charm for 150 years up until the time he published the book, and to a time, which was 1947, it worked really well. And so I casually started, I wasn't as into real estate timing as I am now, of course. I started casually following the 18-year index. And it worked about 50% of the time. In 1979, it worked like a charm. It called the top of the market in the 18 years cycle. It called the bottom of the market. It called the peak of the market in 1995. They said that was a peak. No, exactly wrong. That was a bottom. So I quit following it. And recently, I have a good buddy that trades commodities. He's traded commodities for 30 years. He's a pretty smart guy. He sent me this chart from Timing Solutions that charts cycles. And it's a very expensive software. He said, I just want you to see this and tell me what you think. And so and it goes back to 1987 through 2025, to current day. And I looked at it and compared it against the chart of what's happened to California real estate prices. And guys, it's right on the money. I mean, is it perfect? No. Is it like really close? Yes, really close. So I'm writing about it, and it called the top, and it called the top in 1990. It missed by a year. It called the top in 2006. It didn't miss by anything. It called the bottom in 2012. It didn't miss by anything. And this time, it called the top at 2022, which, if you adjust for inflation, which I often do, because that's real money, not fake money. Even though the inflation numbers are crap. It peaked out at 2022, and that's when the cycle chart peaked out. And the bottom is going to occur, according to the cycle chart, in 2030, which, based on my own calculations, before I had this chart, based on reversion to the mean and analyzing previous cycles, I always thought that the price of homes would turn down somewhere, where they are now, and they would fall for 6 years back into the 2030, 2031 area. And so I drew a trend line on market bottoms, and how far I estimate prices will fall in California when adjusted for inflation is 40%. And just so you don't think I'm crazy, during the 2006 to 2012 downfall, during that bust, they fell 48% when adjusted for inflation. And this bubble is bigger than the last one, so I think my numbers are probably going to end up pretty close. So what I think is going to happen, I think housing prices, over the course of the next 5 years, in California, are going to come down another 35%. They're already down 5%, but it's interesting that all of a sudden the cycle started working again, at least for the last 30 years. So pretty cool.
You've been talking to the real estate to gold ratio for a while now. Is gold still the best place for your money?
Oh my God, you wouldn't believe it. You wouldn't believe it. I follow the gold to price real estate ratio because I like both assets. I've made most of my money in real estate, of course, because I come from a development family. I've been a developer. I'm good at it. But also I like gold. I've always liked gold. So, but what happened in early 2022, the ratio shifted from owning real estate to owning gold. 2022. So back in 2022, I think it was it took it took, when it said you should own, that gold's going to outperform real estate going forward. Okay. In 2022, I don't have the numbers in front of me, I think it took something like 300, let's just say, for example, for the sake of example, 300 ounces of gold to buy the median priced home in the United States. Median, which whatever it was, I think it was around 400,000, 393,000 or something like that. Okay, fast forward to today, almost 3 years later, it takes 131 ounces, guys, of gold. In other words, it takes you could take your 300 ounces of gold it took to buy the house that you sold the house for in mid 2022, and you could use 131 of those ounces to buy the same house back that you sold, and you would still have like 160 ounces of gold left over. That at today's current value of $4,600 an ounce is worth over $500,000. And what that proves to you guys is this. Everything has its day. And people that are wise enough to know that all of a sudden, yeah, can you make a lot of money in real estate? Yes. Can you always make a lot of money in real estate? No. Can you lose money in real estate? Oh, yeah. Why? Leverage. Leverage will eat you up. But there are certain times when one asset class, like gold, for example, compared to real estate, is likely to outperform, and that's the case now. So right now it takes 131 ounces to buy back that house you sold for 300 ounces. So you still have 170 ounces, let's say, of gold in your pocket, and you bought the house back. If housing prices go down as much as I think they do, let's just lose the number of 50%. That means that if gold prices don't even move from today's value, $4,600 an ounce, which I highly doubt, they're going to go up, keep going up, and housing prices fall 40 or 50%, it's not going to take 131 ounces to buy back that house. It's going to take half of that. So it's going to take 65 ounces. So you sold your house for 300 ounces. Now you can buy it back, 5, 6, 7 years later for 65. That means you have 235 ounces of gold left over, priced at $4,600 an ounce. Plus you've got the house. That's how you get ahead in life, folks. That's the way you do it. Now, is that easy to do? No. Does it always work out as well as that? No. But if you took calculated risk like that over the course of your lifetime, I can almost guarantee you're going to be a very wealthy person. You may get married and divorced 3 times. None of your kids may ever talk to you, but you're going to have money. So you got to be aggressive with your money, guys. That things just don't happen by accident. There's cycles in life. We know that. Sometimes an asset's good. Sometimes it isn't good. Sometimes one asset is better relative to another than another times, and that's the situation we're in right now. So, and if I think that minimum, based on what I see going to, and based on the inflate or die concept here in the United States, I think gold is going to a huge number, guys. Huge number. Because I think they're eventually going to have to revalue gold to back the U.S. dollar with the U.S. Treasury bonds with gold so that interest rates don't go to 20%, nobody wants them, and the whole system collapses. So they're going to revalue it. So, but even if it stays the same, you're going to make a fortune, and if gold were, let's just say double. And I think that's very, very possible. I think that's at a minimum. Now it's not going to take 65 ounces of gold at $4,600. It's going to take half of that. It's going to take 33 ounces of gold. Then you're going to have 33 ounces of gold. You're going to buy the house back that you sold for 300 ounces. You're going to have 270 ounces of gold left over at $800 an ounce gold. You're going to be a wealthy guy. I mean, is wealth the most important thing in life, as I'll soon get to? No. Health is 10 times more important. But it's always nice to have money, so have some money so you can work on your health, do the things you want, You can, in other words, you can have both.
It seems President Trump is angry with Fed Chair Jerome Powell. What's up with that?
Because Trump wants Powell, which in theory is an independent, agency of the U.S. government, which is false, but he wants him to lower interest rates. Just keep lowering interest rates. Lower. The debt servicing on the national debt is getting out of control. So in other words, we're in an inflationary economy right now. Trump wants to increase the defense budget by 50%, from $1 trillion a year to $1.5 trillion a year. We aren't paying for that in taxes. You can't raise taxes anymore. People are already suffering with too many taxes. So where's the $0.5 trillion going to come from? He's going to borrow it. Add that onto the Treasury debt. So pretty soon the Treasury debt's going to go to 38, 39, 40, 41, 42. And if interest rates don't come down, the debt servicing is going to go from 1.25, 1.35, 1.4, 1.5, whatever, and it's going to keep going up. And this is a doomsday machine for that to happen with that level of debt. So he just wants to artificially push him down, think that's going to solve the problem, which it isn't. And he's really angry at Powell. He's calling him all these names. He calls him Mr. Dummy or something like that. I can't believe he's doing that. I mean, not saying that Powell's the smartest guy in the world, but he's under a lot of pressure from the President of the United States right now to lower interest rates.
What is the real inflation rate in the U.S.?
4 to 5 percentage point above what the government reports. So let's say we're at 2.7, add 4 to that, 6.7 to 7.7. Let's just call it 7.5%, 8%. That's probably accurate.
Bob, do you have any fitness tips for us?
Yeah, a really good one, guys. I was working out with a trainer about a year ago. I don't know if any of you guys have read the book by David Goggins, Can't Hurt Me. He's an ex-Navy SEAL. He's a maniac, is what he does. But it changed my life. It really, really, really changed my life. And what I learned from that book is not only is physical fitness really, really important to the quality of your life, whether you're successful or unsuccessful, every aspect of your life is improved by being physically fit. What I learned from that book is what he talked about Navy SEAL training. He was a SEAL. And when you go to Navy SEAL training, let's say they invite 100 guys. Every one of those guys is a badass. They're all in great shape, high confident, ex-athletes. You know what percent of those people graduate from Navy SEAL school? On average, 25%. What's the difference? It's all mental. It's all mental, whether you think you can do it or not. That's what I learned. I was never that aware of it before I read that book. So I'm training with my trainer at the gym, and of all things, I mean, we're doing some really some intensive things, right? We're not on a treadmill, any of that kind of stuff. So we're doing burpees. And who does burpees? Navy SEALs, Marines, that kind of thing. So he had me doing 3 sets of 8-rep burpees, where I get down, throw my legs back to a vertical, do a push-up, throw my legs under my back up to a squat position, and jump up in the air. That's 1 rep. Okay? He had me doing 3 sets of 8, which are completely exhausting, guys. I'm like huffing and puffing. When I finish each one of those sets, my hands are on my knees. I'm bent over trying to catch my breath. I came in one day and he said, "We're going to do 3 sets of 10 reps." I go, "Are you high? 10? I can barely do 8." He goes, "We're doing 10." And I said, I can't do that." And he goes, "Would David Goggins say that?" And I go, "No. I did 3 sets of 10 reps. And you know what? Was it that much different? No. It's all mental, guys. You put limits on yourself what you could do. In my mind, I was so exhausted after doing 8 reps of those burpees, I said, there's no way I can do 10. And my trainer, he was a 21-year-old guy that just graduated, that just came out of the military. He was a Marine. He had me doing 10, and it proved it to me. It's mental, guys. So some of you guys out there that thinking, I can't do this, I can't do that, I can't run, I'm too old, I'm too young, I'm too weak. It's mental, guys. It is mental. So if you put your mind to it and just try it. I mean, could I have done like 20 reps? No. Probably not. That's pushing it too far. But could I push it from 8 to 10, which is only 20% more? He made me prove it to myself. And afterwards, I went, whoa. And when I finish those 10 reps, I work out, the gym I work out in is a really good gym, and there's like 3 or 4 ex-Navy SEALs that work out in there. And, you know, this one guy that I'd never met, all of a sudden, when I came up with my last set, and my hands are on my knees, and I'm huffing and puffing, I just happened to turn my head over just to see who's around me, and he was walking by. This ex-Navy SEAL was walking by. He looked at me and smiled and put his thumb up in the air like going, you are one badass guy. And you know what? It's worth it, guys. It's all mental. The people will, I will always remember that. I wasn't looking for any approval from anybody, but he knew. Those are really, really hard. And here I am, my age, I'm probably at least double his age, doing burpees like that, and he's going, whoa, you're my kind of guy. And that's how you do it, guys. It's mental. It's mental. Don't think you can't do it unless you try. So that's my training tip.
Bob, thank you so much for being on This Week in Money.
You're welcome.
My guest has been Robert Campbell, publisher of the Campbell Real Estate Timing Letter, online at realestatetiming.com. He was speaking to us from San Diego. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Rick Ackerman, Josef Schachter, and Robert Campbell. And thank you for listening. If you have any questions for the show or for any of our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.